Click the button to record. Here we go. Gentlemen, good afternoon, everyone. My camera is here, so I'm looking at you now. I was very excited about this panel and the discussion that we had at the last summit, and I want to continue this as we go through the cycle and kind of hear what folks are doing and how things are changing. So if this is your first time attending the summit and the conference, go back and watch the last conference in this panel specifically about the state of the multifamily environment. We're going to get a very diverse conversation here between our panelists on where we're at with the current market. And it's going to be a nice contrast to what was said about 6 months ago. And then I'm going to look forward to hearing from each of you all again in 6 months to hear where we're at. So our order, I don't know if Dan ran through this with you all or not, but we'll go to Jonathan first, then we'll go to Jeremy, then we'll go to Dino, and then we'll go to James. And if I remember correctly, I think this was the same order that we had at the last summit. So very briefly, let's do a quick intro. Tell us about your multifamily investing experience.
Hey, so thanks for having me back in the conference again. It was great fun last time, so I'm glad to be here. My experience is I've been in the business for about 7 years now, 8 years now, and we had built up a portfolio of about 400 units and recently sold the whole kit and caboodle. So I think it's possible that during the last conference, I might have been in contract on those deals, and we exited in February. So that's the background. I don't know if you want me to go into anything else at this point, but basically that's kind of where we are. I think you're muted.
Is that better?
There you go.
All right. Sorry about that. First of all, I just want to say hi to all the fellow panelists. We had a great discussion last time, and thanks for having us back. Really appreciate it. So basically, I have been a passive cash flow investor since 2002, investing in various syndications and all forms of commercial residential real estate. My first apartment investment, I believe, was back in just the beginning of 2008. And I have since, I got to tell you off the top of my head, I don't know how many exactly, but I'm going to guess I've invested in between 8 and 15, actually more than that, about 20 different apartments since. And I focus on kind of Class B and B markets and stabilized cash flow, maybe 80 to 100% occupied, may or may not have any value add upside. I look for predictability. So that's what I typically invest in.
Okay, thank you. And again, it's good to see all of you. I'm glad they're doing it this way. So my name is Dino Pierce. I am a multifamily apartment investor. We acquire B and C class workforce housing in the southeastern portion of the United States. And we also, of course, manage those assets. I've been involved in real estate for 5 years, but solely focused on multifamily for the past 2 years. And right now, our primary focus is on making smart decisions, operating effectively with the current portfolio that we have. And I love this asset as an investment. I feel that, while I'm deep 2 years into multifamily, strictly 5 years real estate, I have a 30-year runway ahead of me, and I'm excited to be on the panel and continue the discussion. Thanks for having me.
Great. James Zhang. I'm based in Dallas, Texas, and I spent the last sort of 15 years as a banker, 10 years as an underwriter for GE Capital, and the last 4 years for 4 to 5 capital originating multifamily debt. So I've done about 500 million in multifamily loans just in the last 4 or 5 years. And I've invested as a limited partner starting in 2015 and across 23 multifamily properties, about 6,500 units here in Texas across sort of your major metros.
Very good. And Sarah, welcome to the panel. Thank you. This conversation, it's a similar one that we had last year. I'm going to ask a couple of pointed questions and we'll kind of go around the room. In your order, you'll follow James. After James speaks, it'll be you. And so that way we don't have any handoffs going on. But just tell us a little bit about your multifamily investing background, and then I'll start us back with Jonathan with our first kind of question.
Sure thing. First of all, can you hear me? Hopefully. All right. So I'm Sarah May, and I started real estate about 10 years ago, mostly as a side gig. I'm an aerospace engineer by training, and kind of did the slow and steady approach for about six or 7 years, buying long-term rentals. And then about 3 years ago, made the switch into working together with other people to buy larger properties, and have been doing that for several years. And I'm both a limited partner in deals as well as an active sponsor in other deals. Right now, I operate actively about 300 apartment units in Colorado, and in passive in about another 500 or so. And excited to be here today and talk about the state of the market. Thanks for coming.
Excellent. Well, thank you everyone for your backgrounds. The first thing that I want to get into, just so we can kind of level set with all of the attendees here, is it's a two-part question. The first part A, is will you be buying actively in 2019? And you can give a little color commentary around what that means to you. Will you actively be buying? And then the second part of the question is going to be, what markets are you watching? Are you investing in? And what markets will you avoid? And you can either do it by a specific geography, or you could do it by, if you're avoiding kind of class property types or area classes altogether, you could do it that way as well. So you have a little bit of freedom here in your response, and we'll start with those two. Will you actively be buying, and what are the markets to watch, invest in, or avoid?
Okay, so am I up?
Yes, sir.
Okay, so the answer to the first question is probably not actively buying this year. I mean, we just exited everything, and in large part because I feel like the market is extremely hot. It's a good time to be getting top dollar for assets, not such a good time to be buying them. And I also felt like there's a lot of sort of risk that's built up in the market at the moment because of the high pricing. So probably not actively investing, with the exception of maybe specific circumstances, specific investors that have special needs, who understand where we are in the market, are willing to accept that risk, or are willing to accept lower returns, and are willing to take the steps necessary to invest in this part of the cycle. So going in at lower leverage and really being defensive about it. That being said, what do I look at? I still focus on the Southeast, but my focus has changed quite a bit. I started out really looking at the C-class properties, and just given my experience with those properties and also my view of the market, I'm extremely wary of those properties at the moment. The reason being, now I take a contrary view to a lot of people. A lot of people say, "Oh, those assets will do well in a recession because they're cheap." I take the contrary view, which is that the people who rent in those assets are your renter by necessity class. They're people who don't really have an option to buy. In most cases, they don't have an option to move up to a better property. They also happen to be the tenants who are the most vulnerable in a recession. They're the first to lose their jobs because they're working in manufacturing, they're working in retail, and they also have no cushion at all. The average 50% of the American population can't afford a $400 expense that's not expected. So when you look at those kinds of assets and you think about sort of where we are in the market cycle and the economic cycle, right now is as good as it gets. I mean, it just doesn't get any better than this, right? It may stay this way for a while, but it ain't getting any better. And the risk to the downside is conversely very high. So when I look at sort of would I buy an asset like that again, So paying a premium for it right now, given who's in there and who's likely to rent that property and what's likely to happen when the inevitable, happens, and whether that's next year or 3 years from now, it doesn't really matter to me because it's the same problem. Paying a premium for a vulnerable tenant base, I'm very wary of those kinds of assets. So that's what I would be avoiding right now. And what would I buy if I were looking? I'd be really looking at B-class properties. So really, really well-located B-class properties that are well-positioned to withstand a nasty downturn.
So I'm actually very much on the same page with Jonathan about currently being active as far as actively investing in multifamily, frankly, in any asset class. I think that we're really, really at the end of a cycle here. Whether you want to call it the equivalent of 2006 or 2007, I don't know, but I feel like we're in one of those times. And I've actually been involved in many sales in the past, since I'd say 2017 on the multifamily side. And I've been very happy to lock in pricing for the past 2 years, and actually a sale this year as well already. Frankly, I'd rather lock in the pricing and then wait for a downturn, see what happens with cap rates, and then maybe take it from there. And so that's my personal strategy. Not everyone has the same strategy. So unless there's some type of very unique pricing, which I would always consider, and there's always deals out there, the general notion is that I'm sitting on the sidelines waiting for a downturn. But still making investments when they come up when they're what I call unique. As far as in terms of either markets or asset classes. So first of all, as a strategy, I personally tend to invest in Class B. I tend to avoid Class A because, those are a lot of institutional properties. You're bidding against institutions often, and therefore you're paying a lower cap rate, which means lower cash flow, which is not good for me as a cash flow investor. I also am concerned during a downturn that the Class A properties tend to have a little bit more of a challenge as far as rents coming down, just because at the high end. My sweet spot is Class B for a lot of the reasons Jonathan mentioned. And as far as Class C goes, I'm actually intrigued by Class C, but what I've learned over the years and found and heard is that Class C can be tough to manage. I look for predictability, and when you have more tenants who can't afford to pay, who may vacate, the turnover may be more frequent. I tend to avoid those types of scenarios because I'm looking for predictability. For someone looking for predictability like me, I feel like the sweet spot is really Class B, which is why I focus on that. Even though I'm intrigued by Class C, given where things have gone over the past decade plus as far as the average household income and the need for really affordable housing and multifamily housing. I would say from a geographic perspective, I tend to invest anywhere in the country that I feel makes sense. And what I mean by that is I'll go in and take a look at the demographics and is it a growing economy in that local area or not? What does the trend look like for the next 10 years? Because I tend to invest about 10 years out, so I have to think really far ahead. And I'll also take a look at a lot of other factors, such as where's population migration patterns going? Look at weather. So, I've invested in self-storage in Florida, but I don't know if I ever invested in multifamily in Florida. And I'd really, not necessarily because I've been presented the opportunity 20 times, but if I was presented the opportunity multiple times, I'd have to think hard about it just in terms of the hurricane risk, for example. And so there's other types of risks. You can go around the country and there's different risks depending where we are in the country. In the north, there may be more heating costs, the expense ratio may be higher. So there's all factors depending on where you're investing. But as a rule, I tend to look at anything what I call makes sense when you kind of add all these factors up just as a generalization. But overall, I would say that I personally consider it a very dangerous time to invest. And the question I ask people is would you invest in a multifamily building in 2006 or 2007 from a cycle timing perspective? And the answer can be yes if the pricing is unique, or the answer could be yes if you build up a lot of padding with a very heavy value add strategy and you do it in time, for example, which is not a strategy that I tend to employ. But generally, it's hard to say yes to that answer compared to investing in a building in 2001 or 2002. So that's my general mindset personally.
Okay, so we have, and we certainly will. There is an if or a but there, if you will. We've closed on a little bit over 100 doors this year. And in all honesty, I'm totally fine with acquiring 0 to 1,000 more in 2019. The thing is, we'll do as many deals as we can, but they have to be deals. If the numbers don't work, we don't move forward, even if it came at some expense to our business, like attorney fees, inspections, things like that. So It's pretty simple for us. We don't fall in love with deals. We want to fall in love with numbers, and we want to be conservative in that underwriting. It's long term for us, and we're focused on cash flow. We too, like our partners, are investors, and we have a lot of skin in the game in concerns of finances, as well as big fiduciary responsibility, the loan, the whole 9 yards. What we want to do is build a solid multifamily portfolio. I agree with the previous two. B is the sweet spot. And when I say C, sometimes I simply mean C by vintage. That C might be located in a B plus, B minus, maybe even A minus area. So when I say C class, that's really what I'm talking about, is the vintage of the building. And we look for workforce housing. One of the luxuries that we have, our firm has the ability to be very selective with our investments, and we opt out until we find the right opportunity. We're not in the business of volume and collecting fees. Like I said earlier, we're investors too. If it doesn't pass our stress test, then we don't move forward. Having said all of that, I do believe there are deals to be found in today's market. You just have to be patient, stick to your underwriting guidelines, and have the ability to say no. If you're not, like I kind of mentioned a little earlier, if you don't have to do deals, I think that's a very fortunate position. Right now, we are in acquisitions mode, but at the same time, we're focused on our operations and operating the current portfolio. As far as we do focus in on the Southeast. We find that though that's the market where we can still find things that are either self-managed, mismanaged, have a lot of value add and upside built into them, as far as being really below market on the rent. What we would avoid and what we stay away from, of course, we look for landlord friendly states, but we really avoid the coast and A-class luxury. Right now, we're in a position where the demand for multifamily workforce housing, it is outpacing the actual supply. But builders and developers, because of the cost of construction, it makes more sense in their brain to develop the A class. So we see an oversupply of that. And when something does happen, we really believe that they're going to take a hit. So we're staying away from A class, staying away from the coast, and trying to look for landlord friendly areas.
All right. So I'll jump in here. So in terms of buying, I look at it in terms of investing as a limited partner. And so I've done one transaction that was a portfolio earlier this year, and then I will probably do 1 to 2 more deals this year. So pretty selective in terms of investing. In terms of the 23 properties, I was actually thinking about sort of net. When you guys were talking about selling deals, Jonathan mentioned that he sold his portfolio. I probably, out of the 23 deals I'm invested in, there's probably 6 or 7 that are on the market are going to be sold this year. So in comparison, yeah, I'm a net seller probably of 4 to 5 deals in comparison in 2019. The areas that I am focused in on are really primary markets in Texas. I'm based in Dallas, so Dallas, Fort Worth, Austin, and Houston are probably my major markets that I'm focused in on. And then in terms of avoiding, I really, unless, even as a limited partner, I like to drive properties and sort of understand the market. And so I really have not invested in secondary or tertiary markets outside of the primary one. So I think those can withstand a little bit more. And so I'm going to still be investing in this year. And the one thing we haven't really talked about in the group so far is really, it's relative for multifamily investors is, okay, you sell all your deals and now you're sitting on cash. How long do you wait? I think one of the nice things as a limited partner is I don't have to sell everything and hold all cash. As a limited partner, I can sort of dip my toe in the water and do, a few deals this year and a few deals next year. And, when I started investing in 2015, everybody thought 2015 was the top. And so I would have been sitting in cash for the last 4 years. So I think just being cautious is important. And then also it's relative.
All right. I'm not sure if James, are you still there, James?
Did I drop off?
Just the last 2 seconds.
Okay. Yeah. Yeah. So I would say also, some people, it's relative, right? So some people are going to sit in cash for a while, but if you're a multifamily investor, you can probably make better investment decisions in multifamily than other asset classes. That's it.
Okay, good deal. So am I buying in 2019? The answer is yes. I think the short answer is kind of what Dino was saying. It has to be a deal, it has to have good cash flow. And if we do have a downturn, it has to be able to, withstand any sort of economic correction. And you just hold longer than your business plan and write it out. We actually just closed on 189 units last month that we syndicated, and things are going well. So yes, I am a buyer, but again, it kind of has to meet those criteria of being a great deal, having great cash flow, and third, being in a great market. Typically, it's those markets that don't have as diverse of an economy, a smaller population, and just not as much going on, that tend to get hit hardest in a recession. So, definitely buy in the better, stronger markets. And again, as far as what markets I'm watching, Colorado markets, that's where I am locally, so that's where I spend most of my focus. I know a lot of the Arizona markets have been doing really well, Florida markets, Texas markets, especially DFW, like James was talking about. And the thing that all those have in common are kind of what I mentioned, the population growth, the job growth, and they're landlord and business friendly. And they're also large metros. They're not 10,000 people in some small town. Those sort of deals are typically harder to sell on the back end. So, that's really what I would look for in a deal right now. Oh, and one last thing, James could probably talk to this, but locking in long-term financing so that you don't end up having to refinance, let's say 3 or 4 years from now, if there is a recession and suddenly your property value is less than what you paid for it and you're not able to refinance on good terms. Just make sure you lock in good 10-year financing in an ideal case to be able to weather the storm, if you will. That's it.
Did we want to jump into, I think the next question on the list was what one word you would use to describe the 2019 market? Jonathan, you want to start there? Oh, there you go.
Yeah.
I didn't see you on there. Is that the next one?
I want to come back to that one.
Okay. All right. Let's save it.
Sorry, gentlemen and Sarah May. What I wanted to go to was what are you watching out for from a possibility of softening in the market? And if your answer is risk, I want to know, what does risk mean to you and how do you define it? So each of you all will kind of have a different, what is the risk that you look at in the market, and what does risk actually mean?
All right. Well, it's kind of a tough question, but I mean, for me, gosh, how do I go about answering this question? So I think a lot of people, the way you look at the market is they're sort of like momentum players, right? Where they're like, if the market is doing well and it's rising, they think that's good and there's less risk. I actually look at things in exactly the opposite way, that the higher the market goes, the riskier it gets, right? The lower cap rates go, the more implied risk is building up into the system, because you have a long-term, sort of long-term mean cap rate for a particular asset in a particular market. And the further you get away from that, the more risk you're building up, right? And it's the same thing with employment, right? Employment, you've got kind of a long-term average. Full employment is considered to be 5%. We're now way below that, right? So the risk there is that it's going to revert to the mean. And to the contrary, if you had suddenly cap rates rising well above the mean, I would say that you've now de-risked the market, right? The least risk is in a market after a crash, right? You don't have a crash followed by another crash, right? You've got to build up again. So the further the market climbs and the further it sort of just stays at these really historically compressed cap rates, the more risk there is building into the system. And what you have is a situation where nobody can really identify what the cause is going to be, right? It's just like in 2007, like nobody knew that Lehman was going to implode, but it did, and it caused the whole financial system to seize up. But if Lehman had imploded at a different time, it wouldn't have made any difference at all. Like, it was a systemically important bank, but it only mattered that it imploded because there was so much risk built up into the system, and that caused everybody to get completely, get really anxious. If it had imploded some other time when there wasn't so much inherent risk, then maybe it wouldn't have had the consequences that it did. So I think we're in a situation now where you just don't know what the risk is. I mean, there's a bunch of things you could identify as potential risks: trade war, a war in Iran. Like, there's a long list of it. But my prediction is that whatever it is will be none of those things that we're thinking of right now, because everyone's thinking about those things. It's going to be something else that hasn't been priced into the market that we just can't really fathom right now. That's going to cause because it's precisely those things that make everybody panic, the thing that they didn't expect. So that's how I'm looking at things. I think there's a lot of risk built up in the system because it's so good, and so good equals complacency, and complacency is what always sets you up for the fall.
So, so just a couple of points to add to that. So first of all, I would say that what I really track in terms of gauging where we are in the cycle and the risk that I'm concerned about is, for instance, yield curve, which can help predict when there may be an economic downturn, which we're already in a negative yield curve scenario. Not that far in, but definitely flashing yellow, red, whatever you want to call it. More importantly, I tend to watch the economy and I tend to watch the stock market, even though I'm not invested at all in the stock market. And the reason why I watch these things is because, to me, 70% of spending, or 70% of GDP in the US is comprised of consumer spending. And if you have, sentiment come down, that for whatever reason, like Jonathan was saying, it's very impossible to predict, but for whatever reason, that will result in the economy coming down, and then we'll have a recession. But what happens in a recession, there's several things that happen that can affect us as multifamily investors. Number one is unemployment goes up, which means vacancies can go up. Number two is that pricing will typically come down because you've got more units on the market and you have to be competitive. Number three, and actually one of the most important things for me from a risk perspective, is an adjustment of cap rates. And I think a lot of people think about cap rates very strongly associated with interest rates, and they are. That's not the only component of cap rates, and it's very important to keep that in mind. Actually, sentiment and psychology play an important factor in cap rates. And so what multiple somebody is willing to pay today that they weren't willing to pay 5 years ago can then change again, regardless of where we are in interest rates. And in fact, I was talking to James, I think it was yesterday, or it was the day before, and he was telling me that, he's seeing in his lending, sorry, James, you may have been wanting to talk about this, so I apologize, but
No
he's
problem.
seeing his lending, interest rates are down this year, but transaction volume in multifamily is down at the same time. Well, that's a little bit of a sentiment issue, right? That's possibly pricing has hit a wall. And so for me, the major risk that I have to look at obviously can affect NOI, which then can affect what your building is worth. And more importantly, the multiple people are willing to pay. And let me tell you, I saw in 2009, 10, and 11, for example, Class C buildings in Texas, which a lot of you are familiar with, trading for 10 caps. And now they're trading for 5 caps. Everybody on the panel knows that. And so, it could go, as Jonathan was saying, it could revert back to the mean, and it may not go that high again because interest rates are now lower, and that is a component of cap rate. I want multiple people willing to pay. But that to me is a huge risk. The risk is we're at a certain compressed cap rate that will change, and it will change regardless of how your building is performing. If your net operating income is the exact same, you will get less for that building. So for someone like me who looks for predictability and is kind of very low risk, I get concerned about these things. And to Jonathan's point, your highest risk in theory is when you're at the end of a cycle, and your lowest risk is when you're at the beginning of a cycle, and your highest risk is when pricing is highest and everything looks great, and your lowest risk is when everyone's really worried and everything looks horrible. And that's what I try to mirror as far as, when I like to deploy the capital, when I try to be really careful.
Okay, so I thank you. Those were great, and I actually agree with every word that you said. For us, it's what we're looking out for is cash flow, leverage, and market. basically the same thing that we've always done, but we're just saying no a lot more. We want to buy cash flowing from day one and then add our value and improve the operations. The leverage, like Sarah was saying earlier, we want to lock it for 10. We want to be able to weather the storm, so that if and when something happens and the cap rates flip and all this, even though we underwrite with, reversion caps elevated, we really try to stress the deal as much as we can. We want to lock it in for 10. And then the market, if all the economic factors, if people aren't wanting to move there, if employment is not increasing, and I understand all of these things can change, but we look at what's happening and what major is coming to the area that probably won't be affected in a softening of a market. So, again, I think there are deals out there. We are happy to say no because we're not needy for deals. We're doing just fine operating the portfolio. We'll do as many as we can, but they have to be deals. If they don't work, we don't move forward. It's that simple. And it's such a long marathon approach, a long game for us when I'm talking about having a 30-year runway in front of us. If the rest of 2019, or even if we don't buy anything for 2 more years, we're just actively looking for that needle in a haystack that comes to us maybe off market. It's going to qualify for some nice debt. It's cash flowing. It's out there. Maybe it might take us 3 years to find one. We're fine with that. We're enjoying the journey. Like all of this process, even in this uncertainty, there's some excitement about it. Fortunately, like I said, we're stable. We don't have to be silly and do a deal just to say now we have X amount, just like an ego thing. It's definitely not that. We are investors. So that's what we're watching out for. And that is what we're doing. And again, we're happy to say no. But when we find one, we will also be ready to say yes as well.
So I think my word last summit for 2019 was softening. My one word. I think that was in my notes. But in terms of softening for the market, what I'm actually looking at is, as a debt provider, I get probably 10 to 15 T12s and rent rolls every day. And when I look at a T12 on almost every deal, the rents are flat on almost every deal. And so that tells me that they're softening because nobody's able to drive rent growth in deals right now. And the difference between probably 6 months to 9 months ago is the spread between people's cap rate and the debt, the interest rate that they're having to pay. And so when we had this conversation in March, 10-year treasury was 2.4 and today it's 2. And so that 40 basis points, that spread has sort of reinvigorated people's demand into looking at deals. Because in November, December, January, February, when interest rates all in sort of for a buyer, they were close to 5% on most deals or high 4s. And now they're high 3s. Rents have not changed in the last 6 to 9 months on deals that I'm looking at. Majority of that spread is just driven by interest rate. And so that's what I'm seeing. Most of the people on this call, they are general partners and they want to buy deals. And so, the number one thing I would say to those people is, number one, protect your principal. And so everybody's looking at deals and everyone's saying, it's a 2x multiple, it's a 1.7x multiple, it's a 15% IRR. I got all of that. But what you want to do, number one, is make sure you get protect your principal. Because if there is a downturn, if you can make it through and not lose your shirt, then you'll still be on this panel 10 years from now.
All right. So I read this question as far as what am I looking for that I think may cause a downturn. And I listed 4 things that I thought would be indicators of when the market might start shifting downward. And the first one actually is interest rates. Like James was saying, we just had a downward shift in interest rates, which I think put more fuel on the fire to keep the current good market going longer. But once we start seeing those come up higher, higher than they even were 2 months ago, that could start to be an indicator when the Fed starts raising their interest rates again as well. Just in general, that could cause a softening to start in the economy. Fewer people want to do deals, prices start going up on assets or start going down on assets. So interest rates, I think, are a big thing to watch out for as we're kind of in this uncertain period of time. The other thing that I think is really big is actually market sentiment. So even if nothing changes, if all of a sudden all the investors start having bad feelings about the market, bad feelings about buying, all of a sudden sales volume goes down, it tends to be a self-fulfilling prophecy. So if market sentiment starts to go down significantly, that's something I watch out for as a potential indicator. Also, I think I said it, but the sales volume, we've been setting record sales volume in the multifamily sector multiple years in a row. And the last report I read, it's down somewhat this year, but not too significantly. But if you start seeing the sales volume, the multifamily transactions plummet, that would be another potential indicator that hard times are ahead. And then the last one, which unfortunately nobody knows, but it's just some sort of trigger event, some sort of geopolitical event that happens, war, famine, who knows, politics, whatever it may be, companies going under, nobody knows what it could be. But if that happens and things might shift a lot quicker, then we could kind of foresee them with the other three items I mentioned. But those are the four: interest rates, market sentiment, sales volume, and trigger events.
Excellent. Very good discussion. Let's see. Does anybody have kind of questions amongst the group here of the panelists or follow-ups to anything that was said?
I wanted to just follow up to something that Sarah was just saying on interest rates. I think interest rates are actually really a double-edged sword. You see on the acquisition side, falling interest rates sort of sparks that energy among investors again, who are thinking they're going to lock in a spread with the cap rate. But historically speaking, and Jeremy was talking about this before with the interest rate inversion, the inverted curve. If interest rates are falling, it's usually an indicator that the economy is not doing well, right? So we're in this kind of weird situation right now where the economy is doing very well and interest rates are falling anyway. And so which indicator is the one that is meaningful to be paying attention to, right? So I think that on the one hand, while falling interest rates may make like the stock market really excited and buyers of property really excited, it could be an indicator that the general economy is really risky, which, going back to Jeremy's point, is that, then what happens to your tenants, right? If that means that there's a recession coming, then you start the whole, sort of bad cycle of, unemployment leading to vacancy, leading to lower rents, leading to you not making your debt service if you're paying a premium for the property. So I just wanted to follow up with that point. Yeah. I'd love the panel to talk about that, Jeremy, and other people to talk about what they think.
Yeah, could I just add to what Jonathan said? Because, you think that intuition would tell you that interest rates go down, prices go up. But to Jonathan's point, in a normal cycle, in a normal economy, which I don't believe we're in either necessarily, because of all of the artificial stimulus and everything that's been happening, and look at where interest rates are today. We would not normally be at these interest rates unless we were having some type of problem. So in the normal economy, interest rates will actually, the Fed will look to tighten to kind of reel in inflation, and then that typically results in a recession at some point, and then they loosen, which means tightening, meaning interest rates going up, and then loosening, meaning interest rates going down. So often people are either trying to lock in the lowest interest rate possible as they're coming up, and they're bidding up properties, and then eventually we get to the top. So to Jonathan's point, this is not necessarily a normal time, and obviously right now, because of all the stimulus that's already there, it's very possible that a reduction in interest rates can add a little fuel to the fire. I do agree. But it is interesting, if you look up the statistics, it's quite interesting that it's counterintuitive how the interest rates work in terms of being correlated to prices.
Yeah, I mean, I'll just add a couple of comments here. I mean, anecdotally, what I see I mean, I have investors pretty much bid on every deal here in DFW. And, I would say probably 2 years ago, every single person on the first round, if they were not at the whisper price, they didn't even get invited to best and final. But it is taking probably 2 to 3 levels of bidding to get to the whisper price in today's market in terms of demand from investors. And the people who have started bidding on properties, I would say in the last 6 months, their returns have been significantly better because of interest rates, and they are taking more leverage on deals. Whether or not it is prudent to take more leverage, or you should, still stay at 70 to 75. A lot of people are driven by returns, leverage returns, in terms of syndications. And so more people are taking leverage at 3.75 to 4% interest rates right now. And that is driving a lot of demand, more so than in the end of last year. So it will absolutely happen in terms of interest rates. So.
And James, are you seeing that those kind of what you're calling higher leveraged properties, are they at like 75, 80, 85%?
80%.
80%. And so are they typically doing like some sort of bridge loan with a floating rate?
No, that's a straight Fannie. This is straight Fannie loan. 125 debt service coverage, 80% right now because interest rates are so low. And, there's a ton of bridge money out there, which is almost like a whole different panel. But Fannie and Freddie right now are super competitive because at 3.75 to 4% interest rates, you can get 75 to 80% leverage on almost every deal right now.
Any other follow-up comments to what we had? Okay. Again, great discussion. I do want to do one quick follow-up question to this question. And it is, if you're not investing in multifamily, or, you're anticipating a softening in the market, are you putting your capital somewhere else? Like, where is your capital sitting? Is it in the bank? Is it under a mattress? Is it in a really good deal that comes along in a rainy day fund? What are you doing? Are you earning any return on it, or are you comfortable on the side getting zero return?
So I'm investing in tin cans and shovels to bury cash in the backyard because I don't think the mattress is safe enough these days.
And little flagpoles, or no?
No, because then people can find it.
Okay.
So,
Jonathan Twombly's address is 123.
But seriously, I think of cash as an opportunity, right? So we're in a very low inflation environment. Having cash is not the risk of cash is not what it was at one time. We could even be seeing a deflationary environment at some point, in which case cash would probably be the best thing you could be holding on to, because your multifamily assets are going to be depreciating in value and your cash is going to be appreciating relative to them. So I don't think that having cash is a bad thing. I think if you invest, all of your cash at the top of the market, you have no cash available for them when the great pricing is available. So you should have an allocation to cash, because cash is an opportunity. So am I investing in anything else now? I have a lot of money sitting in Japanese yen. Other than that, not really. Stock and it's cash, and I moved a lot of my personal portfolio from stocks to bonds. Although I don't think bonds are great, but I think it's a little better than, we're looking forward where we're going if interest rates are declining.
Perfect. Jeremy?
So like James, I'm a limited partner investor, so I have a lot of flexibility. I can literally choose to invest in whatever I want. Theoretically, I don't have to be an expert in any single thing. So I tend to invest across a lot of stuff. Right now I'm being highly opportunistic. And so if I'm always making investments, they're just really, really hard to find. One of the most recent investments I made was ATM machines. I've been investing in ATMs for 11 and a half years and get a little fraction of that surcharge nobody wants to pay, which is nice. But, you know, overall, I would say that most of my money is sitting on the sidelines, and that's sitting in a bank. And if, you know, my suggestion is that there are some online banks now that are actually fairly well known that you can get 2.25% on right now, just having it sit there. It's not great. And I don't personally believe you're keeping up with true inflation, taking into account healthcare, education, everything else, housing, but it's better than nothing. So that's definitely an option. But if you're a limited partner and listening to this, you know, there are always deals. And frankly, even if you're a multifamily investor and you wanted to stick to one, there's always unique opportunities out there. It just finding them right now has become very, very, very difficult because of pricing. And finding them across any asset class has become extremely difficult as well. So it's a problem, not just for multifamily, but universal problem right now.
Jeremy, one follow-up to you. With the vending, just a quick answer. Are you buying the vending machine or the ATM machine, or are you vaulting your money inside of the ATM?
Well, neither in that I'm actually investing in an operator. So I actually have two different operators I'm invested with now, because my first one was 11.5 years ago. I just made an investment to a larger fund, like a top 10 owner in the US. And these are companies that will actually go and deploy the cash. They buy machines, deploy the cash. Some of them use armored cars. So we can get into the whole different, whole different panel. But
they own the machine and they vault the money.
Yes, and and I can go into that a lot if you want me to. I'm sure you don't. But the bottom line is, the more important thing is that it's passive, and that someone else is doing the work. Just like when I invest in multifamily, same thing.
Yeah. The ATM investing is an interesting conversation. Maybe for the next summit, we'll do it. Dino, what do you got?
Yeah, so I actually agree with Jonathan and Jeremy, and
which
I
think
is a change from the previous.
Well, it's in a way. It's in a way. So I mean, I had opportunity to talk with some really experienced. Actually, Yona. I was with Yona yesterday. He's speaking at the same time at this conference. And we were talking, and he had a business partner there, and I had a partner there. And anyway, his partner was saying something like, I love talking to real estate investors because, like, this group, you're like, we're ready to pounce when the market crashes, almost like you're cheering it on. So, you know, as deal-specific direct investment sponsors, our partners, our limited partners, like to see us have skin in the game, in addition to, you know, all the loan consequences, bad boy carve-outs, all this. So I need to invest in my own properties. And like I think Jonathan said, you know, you got to be ready to pull the trigger when whatever softening happens. We want to be there. We've been underwriting. We have the relationships in place. Something's going to come to us eventually. And then, like Jeremy said, it could come your way now, but, you know, it's very hard to find. So we're looking for that, and we're also patiently waiting for the right time. If it takes a softening for that to happen, we'll be ready.
So you're cash and kind of waiting for a deal.
Yes, I'm cash in the bank, not going the backyard route, although that might not be a bad idea. And
if Jonathan has extra shovels, that would be good.
I got some tin cans to sell you, actually.
Yeah, thank you. I mean, look, don't get me wrong. I believe in this investment. Last time, I think a similar question was stated, and Jonathan and I both said, I don't know, maybe gold, and Jeremy killed us. So I'm going to go with, I'm playing the game. Whether or not the opportunity crosses my desk is another question.
Sure. Fair enough. James, how about you?
So the easy answer is cash. But I want to give some context for people who are not lenders. And so what I've seen a lot of people do now is they have become the lender. And what I mean by that is they are not equity anymore. They are preferred debt or mez debt. And so what that means is you're sitting between the equity and the first mortgage. And so that can look in a couple different ways, right? So whereas equity might get a 10 to 15% IRR, let's say on a deal, they are taking the riskiest part of the capital stack, right? So if you buy a deal for $10 million and the equity is the first $2 million, and the property drops to $8 million, that equity is wiped out. But then there's the second stack right there, which is preferred equity or mez debt, and that mez debt piece might only earn 10%, right? No matter what, no matter how well the property does, it only earns 10% or 8%. And then there's the first mortgage, which might be like a Fannie or Freddie loan. And so 2 years ago, there was a very small market for bridge lending. So we might go get a bridge quote and you might get a quote from 2 or 3 lenders. Right now, the bridge lending market is huge. There is 20, 30 bridge lenders out there quoting every deal. And the way that some of these bridge lenders are looking at deals are essentially like, we're going to loan it and we're going to own it. Because if the market goes sideways and the maturity hits in 2021, 2 years from now, they're just going to take back the property and own it at 80% of what people are paying right now.
And they've got a nice deal from it.
They got a nice deal. Well, and then if it goes fine, they collected 6% or 7% or 8%, whatever interest rate, depending on the risk of the deal. If everything goes fine, they got 6 to 8% versus everybody sitting in cash got 1 to 2%. And so it's a very, if you can figure out how to do that well, a lot of institutional guys have figured that out, and they have their debt fund people calling me every day to loan money. And so I have not figured that out exactly how they've done it, but that is maybe an interesting thing for people to consider if they do not want to be in that equity stack, maybe in the preferred equity or mezz debt piece or bridge lending space. They might be able to get a higher return than cash and still sort of be in an asset class that they like because of, fundamentals.
James, can I just add something real quick? Sorry
Absolutely.
to interrupt everybody.
Yeah.
If you're not familiar with preferred equity and you're looking at it, just please be sure to look at what I call the cumulative loan to value, even though you're not really part of the loan stack, because I think there's a lot of people that don't understand it well. And I've done a couple of those deals, and I've done them just to give you all an example of like cumulative loan to value about 50%. They're very unique situations at higher, like 14% rates. The rates right now are like a 10, and you could be in a position where your cumulative loan to value, so to speak, especially with the higher debt levels that James was referring to, that people are leveraging up, you could be in an 80+% situation of your cumulative LTV and not even in a debt position, so to speak. And so just be very careful. If you don't understand anything of what I'm saying, just make sure you do your research, because you can get some yield, but preferred equity specifically and definitely be pretty risky for the return.
I didn't say it was easy.
Yeah.
I also just wanted to follow up with this, which is, as you were speaking, I just found myself thinking like, I've seen this movie before. It just reminds me a lot of 2008, 2007, and I think it's indicative, right? I mean, of where the market is, right? I think this is a sign that the end is closer than the beginning when you've got all of the private bridge money coming out of the woodwork like this.
And if you guys don't read Howard Marks, he said the 4 most dangerous words are, "It's different this time."
Fair enough. And we'll move on to Sarah with that one.
All right. Not much more to add than everybody already has discussed, but I guess just one suggestion that we recently did was, we like investing our money in multifamily. So we try to do that as much as possible. But at the same time, we want cash on hand when a deal does come up. So we were able to get a pretty decent size line of credit, which enables us to be, cash buyers on small properties that we just own ourselves, and do more deals than if we just had to use our own money in savings. We can use our money in savings to invest passively or in our own deals. And then we also have this line of credit, safety net, if you will, in case we need cash down the road. So that was all I wanted to add.
Very good. We've got 20 minutes left. I want to run this all the way until the 45 marker, and we actually do not start the next session until 5. So we could run into our 15-minute break if y'all are okay with that. But I want to get into 2 more questions before we wrap up. The first one, it's not going to be from your list. It's just one that I have thought of now. And so a very quick and short response. What is going to get you excited about opening a potential equity investment in a multifamily deal, what size, everybody said they invest in Class B. It sounds like value add, but what are 3 things outside of it being a B class value add in a growing metro with job and population growth? Let's level the playing field. That's the deal. It's 150 units. What are 2 or 3 things that you're going to look for that are going to get you excited about investing your money today in a deal?
Do we have to assume that the market is the way it is right now, or is that not an assumed?
Market is the way it is right now. What's going to get you excited about an opportunity?
I mean, it would have to be something that was just, a really mispriced deal for this market. Something that I would feel happy buying at a different point in the market cycle. I'm not sure where you're going to find a deal like this, but it would have to have a lot of built-in value right now. Either it's an owner who doesn't know what they've got, or an owner who, it's one of those situations, death, divorce, whatever. Somebody just needs to sell this thing fast, and they're willing to take what they can get for it, without going to market. But other than that, without being able to buy at some kind of discount to intrinsic value,
so
not excited.
So a unique opportunity or something with mismanagement. And when you say quick value, Jonathan, do you mostly mean from an operational optimization perspective, like reducing expenses? Like maybe they've got 8 people on the payroll and you could drop it down to 3 because the owner has been in Hawaii on vacation or something to that
Sure.
effect, versus heavy value add renovation.
I would not want to be risking additional capital in order to try to get the thing up to what its intrinsic value is. I'm looking, something that, it's just being just really run wrong.
Okay.
And the fixes are easy. Yeah.
Okay. Jeremy, how about you?
So just keep in mind, my profile is a little different. So I go into more stabilized stuff with maybe minor value add. That's optional to me. So figure 80 to 100% occupied, stabilized, more predictable stuff. So under that, guys, I'm going to give you a very specific answer, which is that, in a proper B market with a Class B building, if it's a 7 cap or better, I might consider it. And that's a might, by the way, because I'm trying to position myself for where we may end up down the road. And, people are probably laughing, thinking that's absolutely impossible. I actually agree. It's pretty much impossible. But if you want to know what really get my attention, the 7.5 or better will really get my attention. The 7, I'll start to consider it if it falls under that type of criteria.
Is that cap on a T12, or is that going to be on your year 1 pro forma?
No, not on pro forma. No. On T12. Yeah. Making it even more impossible. So.
Dino.
Okay, so what would really get me excited, whether it be limited partner or on the operations side, would be I like to look at a strong, like high historical, high occupancy. So if it shows me, even the past X amount of years, it's always been, 95 to 100% occupied. That would get me excited. If it was an under the radar, undervalued, kind of like what Jonathan was saying, opportunity, that would also get me excited, because I believe that's what you have to find in today's market. And then the operations, since we can't use value add, I will use just the upside. If it was mismanaged, or the management company that was handling things was mismanaging it, self-managed, whatever, and we can come in there, simply operate it better and improve the NOI that way, that would get me really excited, because that's something that I know we can do, or any operator can do with the right team.
James.
Okay, I think I understand the question, but in terms of the 3 things that I'd be looking for in order to get excited, I would say number 1 is the syndicator. Like, who's running this deal, and do they have a track record of sort of working through bad stuff at a property? So number 1, syndicator. Number 2, my cash on cash, I'm probably 6 to 8%. So I need at least 6 to 8% cash on cash day one. And then I need long-term debt on the financing. So if I had those three things, yeah, good.
What does long-term debt mean? 10 years or 10 years or longer?
7 years or longer.
Very good.
Yeah.
Sarah
That's
May.
Sure. So if I had to pick my ideal deal right now that would get me excited, obviously, like everybody said, it has to be a mispriced asset in the market. But what that means typically and realistically right now is there's something about the deal that everybody else is missing, that we can come in and we know that we can add value in a creative way that maybe isn't one of the top 10 checklists that all syndicators use for adding value. Maybe you can take some maintenance space and actually turn it into a unit. Maybe you can start charging common area maintenance fees. You have to be creative with these things to make it work. Or you just know something about rents that they could be a lot higher, and maybe other people don't realize the potential. Great location, great cash flow. Also would love a deal, really clean deal with no deferred maintenance, minimal projects, and that would get me excited. So, what does that mean? Would love to double investors' money in 5 to 6 years, provide 8% plus cash flow to everyone involved. That's what makes a good deal to me.
Okay. Let's go on. Did someone have a question or feedback? Okay. Must have just been some background noise I heard. We'll go in while we've got the time. We'll do really quick. What is the one word that you would describe the 2019 market and how you feel? Let's do that one. And then we'll close with some of your closing advice. So Jonathan, what's one word that you would use to describe the way you're feeling or thinking about the 2019 market?
Anxious.
All right.
One word.
I would say peak pricing. That's 2 words. Sorry, peak.
Okay.
And I would say competitive. And I don't know if we're supposed to expand, so one word would be competitive.
My word this time is lower, and I'll expand a little bit. So lower transaction volume, lower rent growth, lower interest rate, lower returns.
Okay.
Yeah, my phrase is slow and steady. So as an investor, things are still moving. Deals are getting done, but just go slow and steady. Look out for obstacles, roadblocks along the way, but we can keep moving forward.
Okay. Excellent. We will close with some closing remarks on the advice that you would give to someone considering investing, so actually buying in today's market conditions. So Jonathan, what advice would you give to someone who is looking to purchase and or invest as an LP in a multifamily investment this year?
So what I would say is, if you were looking to buy directly, like if you're a sponsor or if you're an investor who's looking to buy, I would really stress test the heck out of your deals. Really make sure that they can withstand, 20% economic vacancy, make sure that in the worst case scenario, and make it a real worst case scenario, not like, oh yeah, occupancy is going to decline by 2 points, and it'll be at 93. I'm talking about some serious economic vacancy. Make sure that you're still going to make your debt service in the worst case scenario. And I think for passive investors, I think, if anybody's showing you deals that, where they're promising you like a 20 IRR and, really juicy returns, I would just be highly skeptical about that. I think the really professional sponsors out there are going to be realistic about returns and going to be telling you, you should expect all in return of 12%, something like that. It may not sound so exciting, but I think someone like that is a lot more realistic and a more trustworthy person to be dealing with.
So I'll take a little bit of a different approach, I think, and I'm going to answer this as if the LP that person you're thinking is actually fairly new. And so, I tell people that I think it's a very dangerous time to invest, which means that it's actually a great time to learn, and you're really not missing out on much while you're learning right now, just based on pricing, in my one person's opinion. So I would say just understand where we are in the cycle, do your research on the cycle and get comfortable with that. And if you're not really familiar with it, make sure you really research, understand it before you actually put your money to work, so you can understand where we are, because real estate and the economy are both cyclical, and it's the nature of how things work. And so you've got to really get a good understanding of that. I would also say that James mentioned this, with a potential for an economic downturn at some point in the future, make sure you're considering a deal that has a relatively long-term locked-in rate if you can. Also make sure that either you're buying it really, really well, or there's some type of value-add business plan associated with it that will not only have a high probability of success, but will probably be able to happen fairly quickly. Because even if you have a value-add plan that appears to have a high probability of success, but may take 3, 4, 5 years to implement, you may not have that time. You may run out of runway depending on what happens with the economy and rent prices and vacancy and all kinds of other factors depending on what the business plan is. So just keep in mind that where we are in the cycle, and then guide your decisions based on that to try to protect yourself and protect your capital, as has been discussed before on this panel.
Yeah, and I would say learn the business of the investment and how to underwrite. Even though you are the limited partner, you should be educated on how the general partners, the active team, are doing this. I mean, Jeremy's a great example, and I've seen him even speak on panels and argue for the fact that passive side is the better end of the business to be on. Having said all that, he can underwrite just as good, if not better, than some of the best active operators out there. And I think you need to have that ability to be able to poke holes in what is being shown to you. So also get to know your team, and finally, get to know your team as far as their track record. Make sure they know how to weather the storm. What happened to them if they were, up and running in the past recession, correction, things like that. Then analyze the opportunities, having all those skills, as well as knowing your team, getting to know, like, and trust them. But in today's market, I mean, the active side, you have to be, and the LPs need to know this, you got to be disciplined on price, stick with the asset class that stick with the locations, and invest for cash flow. With the right management team, you aim to make an impact, you create a community, you finance correctly, you lock in that long-term debt, you choose a great market. I believe that, and I have, not personally, but speaking with operators that have 30 years of experience, what happened to them, in 7, 8, 9. This, if done correctly, can be a recession-proof, profitable asset class. But that's the key. It has to be done correctly. So I encourage everyone, as we are, be patient and wait for the right opportunity. Don't let your ego or falling in love with a location or a deal get in the way. Be an investor and invest in what makes sense. Do the right thing.
My advice is short and sweet. I'm going to put invest for cash flow with a well-capitalized syndicator and a primary market with long-term debt. And we have not really touched on this, but when I look at syndicators, I want to see how much equity they're putting in the deal, but then what is their balance sheet behind it? Because what I've seen is a lot of times syndicators unfortunately don't have as much money as other people, and they're getting non-recourse debt. And when all of a sudden the deal is not capitalized or as well capitalized, that's where stuff starts happening, such as the downward spiral of, taking the washer and dryer from one unit, moving to the other unit, and all of a sudden you can't lease that unit. You got one down unit and it goes to 3 down units and then 5 down units, and then all of a sudden down that spiral. So the point that I would make is well capitalize the deal and well capitalized syndicator.
I'll just add a little bit. So just on some specific underwriting tips for limited partners, I think there's a few heavy hitter numbers that everybody sees in underwriting, and just make sure they're conservative. The big one would be the reversion cap rate. So what the sponsor is predicting the cap rate will be 5 or 10 years down the road when they go to sell. that can make a huge difference to the returns. I would recommend using a number that's more of a long-term historical average. Maybe that's 6.5 to 7.5% in a lot of markets. If you see syndicators doing 5.5 reversion cap rates, it'll make the numbers look really good, but the market's not always going to stay as hot as it is right now. So look at the reversion cap rate, look at rent growth numbers. A few years ago, it was realistic to predict 3%, 4% rent growth for the first couple of years. Right now, not so much. Look at maybe more realistically is 1 to 2% for a lot of markets on the rent growth numbers. The other thing is tax increases. I live in Colorado, and I know the assessor's office has pretty much always been assessing properties at 100% of the purchase price. So if you're not in a non-disclosure state, which most of us are not, look for sponsors that underwrite to that 100% of the purchase price on the tax increases as well. And then as far as the sponsorship team, my advice on that would just be to make sure you understand who is doing what on the sponsorship team. I've looked at a lot of deals as a passive investor, and teams are getting to be 5 or 8 people. And I want to know who's actually has the reins at the end of the day, who's making the decisions, and who's making sure the property is a success. Because with too many people trying to drive the ship, maybe nobody actually has the reins, and bad things can happen. So just make sure you know who's doing what on the team.
Jonathan, Jeremy, Dino, James, Sarah May, thank you all. I think we hit it perfectly from a timing perspective. I'm looking forward, again, January 2020, mark your calendars, please. I want to get a pulse on the market. We're going to have this same conversation again, so we can kind of check in and see where we're at with the cycle and maintain what everybody's feeling and thinking throughout this. James, one thing that I had for you from a follow-up perspective, what does well-capitalized sponsor mean? So let's say you've got a $15 million deal. It's going to be, we'll just call it, for easy math, right? An 80% debt, 20% equity. And so you're looking at an equity check for $3 million on $15 million. What does well-capitalized sponsor mean?
Well, it depends on the rehab plan for that asset. So if you're buying it for $15 million and you're putting, let's say, $5,000 a door into the deal, I want to see at least a contingency on that $5,000. But then also, what is the working capital that you're raising as well, right? So a lot of Fannie Mae loans, they put the rehab money in escrow. And so you actually have to do the work and then apply for the money, right? So making sure you have $200,000 to $300,000 probably in working capital at the property level that you are raising as part of your equity, number one. And then Fannie Mae is going to require 10% of that loan amount in terms of liquidity for the sponsors. But it's very different when it's spread out, as Sarah said, between 5 or 6 people. I would rather see the main person, the main general partner, have a majority of that liquidity. So that if the deal started going, let's say you burned up all that working capital and it actually cost you $7,000 a door, $8,000 a door to work on that deal.
Yep.
I've seen general partners sort of be able to front the money instead of having a capital call back to all the LPs saying, actually, my rehab was too low. Can you guys throw in another 50,000? I would rather the general partner be able to front that money and be able to support the deal. And one example here in Texas that I've seen is, we have hurricanes that come up the Gulf of Mexico. And Jeremy mentioned this on, why he doesn't invest in Florida apartments. A hurricane hit some of the apartments that one of the general partners was invested in. And it knocked out essentially the whole first floor of an apartment. And it was not in a floodplain. So they did not have flood insurance. And so the general partner had to front the money to build all that space back up out of his own pocket. And even though the occupancy was, 60 or 70% today, it's on its way back up to 90. and that was on a Fannie Mae loan. And even Fannie Mae was like, this general partner we trust and, you know, are encouraged by and are willing to give better terms to, because they saw that that guy was, he didn't just walk away, right? If you were a syndicator and you needed to put in money in a deal and you just walked away because it's non-recourse, then, you know, Fannie Mae is always going to remember that. But this guy stepped in and put the money into the deal, fronted the money, fixed the units, and now he's going to sell the property probably next year. But he protected all the LPs, because all the LPs would have been wiped out if he threw the keys back to Fannie Mae. So that's what I mean in terms of well-capitalized syndicator.
Can I add to that? Because I've been through some experiences myself, and I will say, like, one of my interesting learnings over the past 17 years in investing passively as an LP has been that, and it's not really realistic, but when you have the combination of someone who's wealthier, so that means they can actually afford to come in and avoid a capital call on behalf of the group to actually make a loan or whatever structure they would do.
Yes.
But also a person who has the mentality of actually wanting to do so. Just because someone has $5 million in the bank, it doesn't mean they're going to actually rebuild the first floor. They don't have to. There's no legal obligation for them to do that because the hurricane was not foreseen, and you can sue them all you want, but that was just a weather event that wasn't foreseen, and they're not going to lose. And so I think I'm saying this both because obviously investing with someone wealthier can help, but I think that, and I didn't really get into this too much today, but my pure belief is that whenever you're making investment in multifamily or any other asset class, the number one thing is who you're making a bet on. The number two thing is the asset. And I didn't get into that too much today. James did a little bit, just because I'm really worried about pricing and I wanted to focus on that. But in this case, it really, as an LP, make sure you assess who you're making a bet on as best as you can. Hopefully, preferably meeting them in person if you can, because that's what it's going to come down to. And you're giving away control to somebody on a day-to-day basis. You want to make sure you're giving away that control to the right person.
Fantastic point, Jeremy. I think that's a great point to kind of close on, is just the trust and having that sponsor being the most important thing to the success of that deal for the various reasons we've gone through. And then, you know, having that great opportunity in the property itself is really being that secondary component to it. So again, Jonathan, Jeremy, Dino, James, Sarah May, thank you all so much for the content and the discussion here. Again, mark your calendar, January 2020, nextmfin.com to go get more information. We want to have all of you guys and the lady back for a same discussion to go through where we're at in the market. It's going to be an interesting time as we finish out the rest of the year. And I want to see where everybody comes in at starting in January, so we can kind of reset and calibrate our goals and expectations for 2020 ahead. So at this point, we're going to wrap up. We're going to take a short break. I think we've got about 10 minutes here until the next session starts at 5 p.m. Eastern. We're going to have Hadar Orkabi talking about multifamily investing from out of state or overseas. So that'll be coming up at 5 o'clock. You've got 10-minute break. And again, Jonathan, Jeremy, Dino, James, Sarah May, thank you so much. And I look forward to speaking with you five again in January 2020 on where we're at with the market.
Thank you.
Thanks for the opportunity. Good to see you.